All right, let's do it, folks. One and all, good morning. Welcome to the Street Today here from Post 35 on the floor of the New York Stock Exchange. It's Wednesday, March 15th. I'm JD Durkin. About an hour or so into trading, markets are in the red, to put it lightly, as pressure on the financial sector continues to mount. Big breaking news and developing news on Credit Suisse we'll get into coming up in just a bit. What else will we get into in just a bit? On the show this morning, we talked the latest on the Silicon Valley Bank fallout, plus tell you why bank stocks are bouncing back a bit, at least they were. Plus, we'll break down what's going on, as we just said, with Credit Suisse as shares hit a record low. And finally, we'll tell you how recession concerns are weighing on the price of oil, a jam-packed half-ish hour ahead. For more on those stories and so much more, we now bring in Mr. Martin Baccardax, the only man I would want to talk to help make sense of all this chaos. Martin is our senior editor and our chief markets correspondent. Martin, good morning.
Good morning. I mean, what have we witnessed over the past 10 days? This has been extraordinary, and the hits just keep on coming, don't they?
So let's start there. What are the latest hits that keep on coming? Because this time yesterday, it kind of seemed like perhaps we had, at the very least, a bit of a relief rally, trying to put some of the trepidation behind us. We're waking up to what some people fear is some banking or perceptions of banking instability now over in Europe. Give me your sense on what's driving things as of 10:31 a.m. here on the East Coast.
Yeah, I mean, ultimately, JD, I think what is happening is that this is a typical banking crisis in that the reactions are very often irrational, and they aren't necessarily based on fundamentals, and very often based on confidence, or for the most part, a lack thereof. I mean, at its essence, JD, we are looking at economic growth that is fueled by credit, and credit is fueled by lending. When banks are unlikely to lend to one another as a result of questions about the safety and probity of assets inside them, they are very less likely to lend to the rest of us. So that usually triggers a pullback in loan growth, which lowers credit growth, which by proxy slows economic growth. So whilst people are certainly concerned about the balance sheet quality for a lot of lenders in the United States and indeed in Europe, the larger implication that we're seeing in markets right now is that all of this is going to lead to significant economic decline with respect to GDP growth. I would say the latter part of that story is more likely than the former. I think that a lot of the regulations that have been put in place after the financial crisis actually make banks a bit more stiff in terms of the resolve and in terms of the quality of the asset base than the markets are indicating right now. But again, the market tends to sort itself out chaotically, and that's precisely what's happening. With respect to growth prospects, I think, JD, what we're seeing most viscerally is that really sharp pullback in U.S. Treasury bond yields. Two-year Treasury notes are trading around 3.8% this morning. That's 50 basis points from where they were even yesterday afternoon, and it's well more than 120 basis points compared to where they traded, which seems like an eternity ago, but was only last week, just after Fed Chairman Jerome Powell spoke to the Senate Banking Committee. That's how far markets have come in this 7-day period.
Yeah, that was a week ago, wasn't it? It feels as if it's much longer. I feel like we've all aged quite a bit between last Wednesday morning, which right about now, yeah, that was a half hour into the Senate day, and we saw the 2-year move, and we saw the CME Group's FedWatch number go one direction, and we're living in a whole new world today. Let me ask you here about Moody's downgrading the entire banking segment to negative. I believe to negative from stable, if I'm not mistaken. Yeah. They cited a rapidly deteriorating operating environment. Give me your sense on how big a deal that is now for Moody's to weigh in, and they're also flagging other potential names that are being worth looking at, like First Republic, Zion, several other of these regional names, places like Kansas City, Salt Lake City, and certainly First Republic here in New York.
Yes, I think ultimately what Moody's is trying to do, even though I think from a broad brush perspective they were a little bit overstating the fact, is they want investors to look at the quality of the asset base and indeed the deposit base prior to making decisions about investments in any particular institution. Now, downgrading the whole of the U.S. sector to negative, again, seems like a bit of an overreaction. I mean, U.S. banks are well capitalized and they remain so, largely as a result of big changes that were put forth in the wake of the financial crisis. The Fed has stress tested many institutions, some less so than others, but nonetheless, we have FDIC deposit guarantees in place. We have this Fed lending window in place. and we have very well capitalized institutions. So I'm not buying what Moody's is saying across the board, but I think what they are trying to do in their own unique way is to demand that investors look under the hood with regards to these different banks. And when they do so, they can make their own judgment. Separating fundamental from narrative at this point is incredibly important, because otherwise you begin to drag banks into the vortex of disapproval, even if they have solid balance sheets and good operating practices. Now, all banks are going to suffer as a result. There's no way around that. But looking at the fundamentals will allow investors to separate the good from the bad, and again, the fundamentals from the narrative.
I mean, outside of just the broader regional bank story, have we learned much in the last 24 hours or so, specifically with the Silicon Valley Bank situation, or has that more or less stabilized and now we're sort of seeing, I don't want to use, I'm not using the word contagion, but we are seeing some reverberations, shall we say, into other parts of the conversation now?
Yes, I think that's the best way to describe it, JD. Essentially, it doesn't appear that the contagion is spread through to other institutions. I think it's worth remembering that Signature Bank, which was closed on Sunday, was also part of a regulatory probe, and indeed, if I'm not mistaken, a criminal probe as a result of some of the things that might have been happening in its sort of Bitcoin and digital currency lending. There were some money laundering accusations. So Signature Bank's fate may be completely separate from what we experienced with the result of Silicon Valley Bank. And Silicon Valley Bank looks to have been isolated, at least to a certain degree, as a result of the federal Deposit Insurance Corporation's deposit guarantee and the Fed lending window. But that doesn't mean that the conditions that pushed Silicon Valley Bank over the edge are not similar in other U.S. institutions. So as a result, I think, JD, what we are seeing is people checking under the hood to make sure that the liability mismatch was the biggest risk failure at SVB isn't being replicated elsewhere. And if it is, to what degree is that going to wash over the deposit base, and therefore, as a result, have the deposit base flee to more sort of established and veneered institutions. That was a big part of the reason why we saw the big bank stock decline on Monday. And furthermore, JD, when people did check under the hood, it was part of the big rally that we experienced yesterday. Today, that's going to be hard to pick through, simply because the whole of the sector has been tarred with the same brush. People aren't asking questions. They're just taking money off the table. And again, that's very typical in a banking crisis. The market sorts itself out chaotically and then methodically comes back into place.
Absolutely. Our guest yesterday morning was John Petrides of Tocqueville Asset Management. He said that he sees the odds of a U.S. recession going up in the wake of his bank collapse. He's certainly not alone, but let's take a look at what John had to say, and I'll ask you about it on the other side here, Martin. Here's John.
We're now in the credit concern portion of the business cycle. Right now, presumably credit is going to tighten across the board. I mean, if you run a bank after and you're a chief loan officer, you're probably calling all your loan people and saying, listen, you really have to scrub whoever we're making a loan out to because we can't have any issues now. We have to be pristine. And that should help in terms of slowing the economy and potentially throw us into recession. I presume that the odds of recession have gone up on the back of what's happened over the past couple of days.
Martin, what do you think here? I know it's difficult to necessarily always weigh in on the increased odds of a recession, but like I said, John's not alone.
No, he's absolutely not. And I think what he's describing is very much what is taking place. Again, maybe not necessarily born as a result of logic, but simply born as a result of people sort of protecting themselves. Loan officers not willing to have their loan books at risk as a result of this extra scrutiny are definitely going to pull back on some more sort of suspect credit agreements. And that is going to slow credit growth across the whole of the economy as it tumbles from institution to institution. Interbank funding rates are going to spike higher, simply a result of extra perceived risk. When those rates spike higher, they are then passed on to borrowers out in the real economy. When borrowing becomes more expensive as a result, then projects are sometimes shelved. Hiring is slowed as a result of the shelving of those products, and on down the line, it spills in terms of economic prospects. So I think what he is saying certainly has a lot of merit. And I do believe when you look at what's happening in the bond market and you see what's happening in commodity prices in other corners of the financial sector, that does suggest that analysts and investors are absolutely concerned about the increased recession risk. It was already on the back burner for the second half of this year. It may be brought forward as a result.
Martin, excuse me, I've been listening to lots of interviews over the course of the last several days, including the likes of which include Kevin OLeary. And one thing that he has said and others have said is, you know, kind of this idea of it's a question, and it's a question I want to ask you. What prevents an irresponsible bank manager now from acting recklessly, knowing that the government is essentially going to come in and make his or her customer base whole, regardless of any irresponsible actions by management?
Well, I mean, the president answered that question pretty directly earlier this week, didn't he, JG? You're going to be fired if you do. I'm not sure O'Leary's criticism has any particular merit in this case. The conditions of being taken over by the FDIC or indeed having to come cap in hand to federal regulators if your bank fails as a result of reckless activity is that you're going to be out on the street. Now, that's not necessarily good in one sense, because banks that are actually behaving properly and see something underneath that they are concerned about might be reluctant to flag it to regulators as a result of them being concerned that they will be taken over and they will lose their jobs as a result. But to say that bankers are going to act more recklessly because the FDIC is going to back deposits is, just quite frankly absurd, isn't borne out by the facts, and indeed was addressed by the president on Monday when he said, if that is the case, management's out the door, which is precisely what happened at SVB.
Yeah, we did get those comments from the president in an effort to try and calm things down before trading kicked off on Monday. You and I were live on air shortly afterwards to break that down, so thank you for that. Okay, let's talk FedWatch. What's our current forecast? What are we looking at? I know this thing whipsaws by the day, but what's the latest?
Yeah, it flipped upside down this morning, JD. Now we are seeing the bulk of betting that suggests the Fed is going to pause its rate hike cycle when it meets next week in Washington. I think the number I saw was somewhere around 69% betting that the Fed funds rate will stick at 4.5 to 4.75%. Most of that was in the wake of the Credit Suisse story, and I'll know we'll get to that in a moment. But JD, it's sometimes difficult to disentangle what we are seeing in FedWatch and interest rate markets when everything is moving at the same time. In other words, there's very often a mechanical connection to what we are seeing in two-year Treasury note yields and what comes up on the screen with respect to the CME Group FedWatch. And what is moving two-year Treasury note yields might not necessarily be indicative of what's happening at Credit Suisse or indeed what's happening in Fed rate markets or the economy or everything else like that. It might be an amalgam of concerns that are blending into a very liquid price, and as a result, they're reflecting changes in a relatively illiquid market such as Fed fund futures. So whilst I do believe that the market is moving towards a consensus that says the Fed is going to stay at 4.5 to 5%, 4.5 to 4.75%, it's by no means a done deal. And it may sort of take a few days to pick through until some of the moving parts in the whole compass of the equation come to, not a halt, but at least come to some sort of stabilization.
All right, so let's go there now. Of course, the top story of the moment, like Martin just mentioned, Credit Suisse hitting a new record low this morning after its biggest banker, the Saudi National Bank, ruled out providing any more funding. In an interview with Bloomberg, the Saudi National Bank chairman said, quote, "We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in, whether it be by our regulator or the European regulator or the Swiss regulator. We're not inclined to get into a new regulatory regime." Martin, can you help us better understand what exactly is going on here?
This is a great story, if for no other reason, JD, that it illustrates the chaos that often comes as a result of a lack of confidence in the banking sector. Really, this wasn't particularly an important event on the calendar for a lot of people who look at the European banking sector or indeed who follow Credit Suisse, because they are well into their turnaround plan and for the most part the worst of their situation, I wouldn't necessarily say is behind them, but has been flagged in headlines and in financial markets for a number of months now. So what you have is a banking congress that took place in Riyadh. There were a bunch of executives on stage who were talking about Credit Suisse and the European banking sector in general. And indeed, the Saudi National Bank chairman spoke on Bloomberg television and was just asked kind of a relatively straightforward question about whether they wanted to boost their equity stake in case Credit Suisse were to make an equity call. Credit Suisse hasn't talked about making an equity call. It's just something that was sort of dreamed up as part of the conversation. Credit Suisse says it's well capitalized, and the numbers bear that out. Its liquidity ratio is about 144%, and that's incredibly strong, even by the European context. So the idea of it raising capital was a bit of a non sequitur, and as a result, the Swiss National Bank chairman answered it as such. But because people are so sensitive to headline risk and, of course, the associated spillover of SVB, they marked down Credit Suisse very, very quickly. Its credit default swap prices went through the roof. The stock traded at a record low, and European banks were pulled down into the vortex. So again, just another perfect example of something that wasn't necessarily a specific event risk, but spilled into the situation we see now, more as a result of confidence than fundamentals.
All right, so that's a really good point of context that I would want viewers to take away from you. It's not a connected situation insofar as the fundamentals, but perception drives reality, right? Is that more or less what we're? I mean, people were kind of in a reactionary, knee-jerk, kind of jumpy environment right now with any perceptions.
You couldn't be more correct, JD. At the end of the day, banking is a confidence game, and I know that we talk about that term and sometimes use it in a negative sort of in a negative context, and that's not what I mean to indicate. But what I do mean to indicate is that with the reality of fractional reserve banking, in other words, the amount of money that sits in a bank on any given day doesn't really reflect the deposit base because those deposits are put out into the marketplace in order to engender returns, makes banking a confidence game. If investors do not have complete and absolute confidence in the ability of bank managers to run the business, and if they don't have complete and utter confidence in the safety of deposits, they're going to pull the money out, and that has a cascading effect. So even if there aren't any fundamental concerns, the confidence situation can ultimately create fundamental concerns. It becomes a self-fulfilling prophecy. Whether we're seeing that with Credit Suisse is hard to know just yet because it's only in the early hours of this story. But it is something that could accelerate over the coming days and months, particularly if central banks were to maintain their rate hiking cycles, because to some degree, the conditions that led to SVB's collapse are replicated at Credit Suisse, not to the exact degree, but there still is that pressure of liability mismatch as a result of bond portfolios which are sitting on unrealized losses based on higher European Central Bank and Swiss National Bank base rates.
And then finally on this, any risk of that spread of perception now to other European banks or other big banking names that maybe we're not yet talking about, but then again, on Friday or even yesterday, we weren't talking about Credit Suisse, and here we are. So what is the likelihood that, perhaps later in this week, you and I are sitting there having this conversation, and it's another banking name that's not even on our radar as of yet?
I think it could be reasonably high, JD, and I think a lot will depend on what happens with the European Central Bank tomorrow. It has its own rate decision in Frankfurt, which should come down at about 7:30, 7:45 a.m. New York time. Now, the betting prior to today was that the ECB was going to raise rates about 50 basis points as a result of what they're seeing with inflationary pressures in the European economy. It's worth mentioning, JD, and it's something that I do like to repeat on a lot of occasions because it's the key differentiator between the ECB and the Fed. The Fed has a dual mandate of price stability and full employment. The ECB only has, as was famously said by Jean-Claude Trichet, one needle, the single needle of price stability. That's the only thing that their rate decisions are meant to be predicated on. So they are very likely to carry on with rate hikes tomorrow. Now, if they do so, European banks are sitting on hundreds of billions of dollars of government bonds, which they were encouraged to purchase in order to make sure that their balance sheets were of the highest quality. the prices of those are going to decline and the yields are going to rise as a result of the ECB's tightening. So you're going to see similar pressures to the ones that we witnessed in SVB as a result of that. What will be interesting and indeed probably crucial for the European banking sector is whether the ECB says it's going to lay off some of those rate hikes going forward in order to make sure that they maintain financial stability and indeed confidence in the regional banking sector. But how they do that while still executing their single mandate of price stability will be extremely complicated.
Absolutely. Okay, so I mean, my goodness. First of all, Martin, thank you for all of that context. I know I thank you for this stuff, but being able to simply break it down is really a gift for the rest of us. So I appreciate it. Okay, let's talk retail sales, because that in a normal week when we didn't have the rest of this, this would be like the other big thing with CPI we were talking a lot about, right? I mean, and it's funny. I got to this point of the show and I was like, retail sales. We were talking retail. Oh yeah, there was retail sales data, right? Okay, but it is worth noting. I mean, for sure, we cover it. Out this morning showing a 0.4% decline, showing that inflation is finally starting to catch up with shoppers a bit. Perhaps your reaction to what we saw, or what should we know?
To some degree, JD, I think it was simply what was purchased in January is being paid for in February. And by that, I mean the January number was actually revised higher to a gain of about 3.2%. So as a result, we had a lower than expected reading in February. I think that February is traditionally a very difficult month for all sorts of retailers because people have spent as much as they can over the holiday period, and then whatever extra was left over was probably laid out in the bargains that are put in place in January when retailers get rid of a lot of their excess inventory. February, exceedingly difficult as a result of that. People just don't have the cash required to extend discretionary spending, and that was played out in the numbers today. I think ultimately what will be interesting is to what degree inflation continues to hold back discretionary spending going into maybe the 3 months heading into June, because that, of course, will have a tremendous influence on some of the inflation benchmarks that the Fed is so focused on. Core inflation ex housing is how they describe it. But essentially what the Fed is saying is we are seeing price pressures that are outside of the housing market that are indicative of a strong labor force and a lot of extra money in people's bank accounts that they can use to buy services. The February retail sales numbers suggest that some of the steam might be coming out of that, and as a result, that would probably lead to disinflationary pressures in the most important metric in the Fed's mind with regards to inflation. So that could have really meaningful implications for the forward projections that the Fed has on interest rates, and as a result, where we are all going to get in terms of the terminal Fed funds rate, which at this point, JD, seems to be no higher than 5%, which is lower than the Fed has been warning us for the past few weeks. But of course, the Fed hasn't said anything post SVB because it's in that blackout period that they typically execute going into a policy meeting.
Sure. Martin, anything else that's top of mind for you with regards to either retail sales, data points, Fed, everything we've hit on up till now, for additional context and perspective before we pivot on and hit a little quick moving rapid fire?
Well, the only thing I would say, JD, is that I think if the Fed did want to pause next week as a result of the turmoil that we're seeing in the banking sector, there would be enough information and data to justify it. The weaker retail sales, the slowing of PPI inflation, the fact that the only nasty surprise we got out of the CPI reading yesterday was a modestly faster than expected core reading. Ultimately, the Fed wouldn't lose any credibility and would probably actually gain a lot of favor in the markets if next Wednesday it's paused on its rate hike, and then if it saw data dictate accelerated rate hikes into the springtime. But the pause would buy them a little bit of time to understand exactly what influence the SVB collapse has had on the banking sector here in the United States and elsewhere. But I just don't think they're going to do it. So it is going to be, I think, an exceedingly difficult trading environment into the Fed and afterwards, because I do believe they are going to hold the line. And as a result, that's going to create a lot of complications for just about everybody.
Absolutely. Okay, time now for our rapid fire segment. It's a little bit of both. with our remaining time. First up, let's talk Foxconn. Low battery indeed. The company sees cautious 2023 electronics demand. What's up with that?
If you're a tech investor, this is a company that you absolutely have to watch because it's the biggest contract chip maker in the world, and it's a key assembler for the Apple iPhone. So what Foxconn says about consumer demand is very often echoed by Apple and reflected in their quarterly earnings. What Foxconn is saying is that consumer electronics demand is probably going to be flat to last year as a result of this pullback in consumer spending, the still uncertain growth in China, and a host of other factors. Now, they say some of that, from their company perspective, is going to be offset by a lot of cloud spending, and we've talked about that ad nauseum with regards to AI and the growth of the cloud space as far as that is concerned. But what Foxconn is saying about consumer demand is extremely important, particularly with respect to Apple, and I'll be interested to see to what degree it does echo when we get those numbers in probably about a month and a half time.
A really important one to follow here is what's been happening with oil this morning. Oil hits year-to-date lows. Some recession concerns in the mix. Don't slip indeed. What's up with that there, Martin?
Yeah, no question about it, JD. Actually, now with the accelerating losses, we're looking at numbers that we haven't seen since December of 2021 for WTI crude futures. I saw them last in the high $67 range. Obviously, the dollar has raced higher in global foreign exchange markets as investors flight to safety, and that, as a result, puts corresponding downward pressure on oil prices. But what investors are seeing writ large is the fact that if the banking crisis were to spiral out of control, economic growth would absolutely slow, and we already have questions as to what kind of pace we are going to see in China's expansion over not only the near term, but the second half of the year. And China, of course, is the biggest importer of oil products in the world. So we are just seeing a really significant downshift in price expectation. That's being played out in WTI crude. And as a result, JD, it shouldn't take too long for Americans to see that at the pump prices as well.
Third and final, bye-bye ByteDance. It's like the NSYNC song. TikTok considers a split from Chinese parent company to soothe U.S. concerns. What's going on there?
Well, this is reporting from Bloomberg, and it does reflect what we've seen echoed in a couple of other conversations. TikTok will probably, if it turns out that national security concerns would shut down its operations here in the United States, spin off its U.S. operations into a standalone company and completely separate from ByteDance. They will probably do the same in Europe as well, but the U.S. operations could be valued at anywhere between 40 and 50 billion U.S. dollars. It might be as a company sale, it might be as an IPO. Ultimately, Oracle might benefit from this as well, JD, because there's been consistent talk about them hosting the TikTok data and keeping it safe with respect to concerns about maybe it being used for nefarious purposes by the Chinese government. So this is an interesting push forward of a story that's been dragging for a number of months and indeed years now. And it's important not only for TikTok, but of course for social media companies here in the United States, which might be happy to see it disappear because they, of course, would see significant increases in users if it would.
Yeah, it'd be fascinating to see the Oracles or whoever else from those conversations originally now come back into the fold as the story develops. We'll closely track that. Martin, this is a jam-packed, very important show this morning, especially for the Credit Suisse context, and I'm thankful, as always, the great Martin Baccardax. Thank you.
Thanks, JD.
You got it, man. We'll see you again soon. We'll do it again soon. Thank you to those of you at home watching for being here with us today. That's going to do it for The Street today. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.